Now, Indian equity markets remain largely steady despite reports of US strikes on Venezuelan military and port facilities over the New Year weekend. Instead of reacting sharply to geopolitical headlines, investors focused on domestic factors, especially interest rate expectations. Benchmark indices edged higher, technology stocks slipped 1 to 2%, while rate sensitive sectors such as banking and automobiles gained 1 to 2%. Most of the other sectors traded in narrow range, signaling that markets saw this development as a short term risk rather than a trigger for broader economic shock. While Indian Asian markets, particularly those heavy in AI and technology, rallied on expectations of further US Federal Reserve rate cuts, crude oil markets also reflected this calm. Brent crude hovered around $61 per barrel even after OPEC Plus decided to maintain production levels through March. The limited reaction is largely because Venezuelan crude contributes only about 1% of global supply. Other asset markets showed selective hedging rather than broad risk aversion. Market experts noted that Venezuelan supply has effectively been absent from global markets for some time due to sanctions. Analysts expect any near-term rise in crude prices to be capped between $65 and $70 per barrel unless the conflict widens significantly. Now, what oil prices would actually hurt India? Economists outline clear levels at which oil prices would start impacting India's macro stability, which is $85 per barrel would raise India's import bill, slow disinflation, and complicate fiscal and monetary policy. Every $10 increase in crude prices adds 17 to $18 billion to India's import bill and widens the current account deficit by about 0.4% of GDP. India's direct corporate exposure to Venezuela remains small. Companies with links such as ONGC Videsh, Indian Oil, Oil India, Reliance Industries, Nayara Energy, MRPL, Sun Pharma, Glenmark Pharma, and Jindal Steel and Power are involved mainly through minority stakes or legacy operations. Analysts say that environment remains supportive for Indian oil marketing companies, helping preserve margins. However, policy risks such as potential changes in fuel taxation remain worth watching. That episode highlights longer term structural shifts. Yes, higher baseline of geopolitical risk in energy and critical resources, increased use of sanctions and financial controls as geopolitical tools, a more fragmented global order where political alignment matters alongside economic fundamentals. Why India is well positioned? India's resilience stems from diversified crude sourcing, nearly $700 billion in foreign exchange reserves, and a credible inflation targeting framework. As long as oil prices stay below key levels, markets are likely to treat Venezuela related developments as background noise.